So now we're going to look at what's happening abroad. What are some of the things that are shifting around the world? Where are things going in terms of differentials, in terms of flow? So one of the key things that we wanted to talk about again is Lunar New Year, and one of the bigger hits is going to come from China. So that this is looking at BNF, looking at and just summarizing what the Ministry of Transport is forecasting. So when we look at 2019, you can see what is normal. Then when you look at 2020, obviously there was that big drop due to COVID. And then 2021, you can see what the forecast was and then where things are. And you can see right now in 2022, they're guiding to something similar. Now, I based on where things are going, what the drop is going to look like, they're expecting to see another drop versus 2020, versus 2019 or a normal year. And it may be a bit stricter due to just how much Omicron has spread, and Delta, I should say, just COVID in general, has spread through China. They are maintaining their zero tolerance policy. That may have to adjust just given the difficulty of containing COVID at this point, because I feel like with this new strain, if you look at someone with COVID, you get it. It's, luckily, knock on wood for those out there, if you get it, it's fairly mild, maybe a bad cold, like at least from personal experience. So, which I was asymptomatic, thankfully. So now when we look at where we are in 2022 for their demand, that's why when we look at they're not selling tickets for the Olympics. They're going to a Lunar New Year. I don't see a lot of demand really coming in most of February. So that's where we see some of these slowdowns. And I should say that against seasonal lines, there's always going to be more travel than normal due to the holiday. It's just going to be much less, not only versus normal of 2019, but also versus expectations. And that's also strengthened by the increase in job losses, the slowdown in just general consumption, and that's some of the other headwinds that we continue to highlight and talk about on these shows. In the Econ Show, we talked about it again in segment 5 of the Econ Show and in our insights. So now when we look at crude oil in transit, you can see that there's been a marked shift higher. We're now at seasonally adjusted all-time highs for crude oil in transit. That's not surprising given where we've seen some of these purchases through January. And it's not just coming from China. As we said, there's other purchases going into Asia. There's other movements happening right now. So we do have more crude oil in transit at this point. But when we look at crude oil on the water, which is, again, the bigger piece of the pie, you can see that we do have a seasonally adjusted high. Things are moving up, and it's because we still have a lot of crude oil that's sitting in floating storage, and now we also have more in transit. We had a fairly sizable reversal in the amount of floating storage in West Africa, and it's really because China has slowed down their purchasing coming from West Africa, and now they're trying to work on some deals in terms of what's going to go into other pieces of Asia. And we are seeing some Chinese demand of Russian crudes remaining fairly elevated, which we'll talk about in a minute. But that's why there is more crude oil on the water. And as you can see, going back since 2016, it's the most ever for this time of year. Which is why, again, when you look at crude oil in transit, we're still right back at these elevated levels. We do have more oil in moving. And again, a lot of this crude was purchased through the first weeks of January. And you can buy Jan 1 for loading January 15th or January 20th or January 25th. So the fact that we're just now seeing it go in motion isn't crazy, because it's just a matter of when is it loaded, when is it pushing off. So that's why, based on all of the purchases China made in the early part of the month, is going to start to come now, and you'll see it happen in oil in transit. And some of this will come from floating storage. So we're tracking 2021 almost perfectly. We're still at a seasonally adjusted all-time high for this time of year, but we expect it to come down a bit. Again, crude going from floating storage into transit, and then going from transit back into floating storage. So this is going to keep us very well elevated through the first few weeks of the year, and I think much closer to where we were versus 2021. So now when we look at U.S. crude exports, we expect to see more pressure remain in the system, but it'll go up and down. Like, it's not going to be a consistent move down. We'll have spikes, then come a little bit lower. So here, finished motor gasoline dropped 133,000 barrels a day. That's 388,000 below the 5-year average. Distillate, 209,000 below the versus last week, 244,000 below the 5-year average. That's going to remain a headwind. And then propylene had a drop of 607,000 barrels a day. That's 228,000 below the 5-year average. We expect to see that stay a bit elevated in terms, a bit depressed, just given where some of the pricing is right now between LPG and some other liquids, and just where some of the competition is going to come into play. We had a bounce in crude oil exports as we expected. It's back to 2.6 million. It had an increase of 655,000 barrels. It'll still remain depressed, but that move down to 1.9 was a bit low. Asia purchasing has really slowed down, and we just expect the agreed upon that was already purchased still going into Europe, but we don't expect too much going additional, just given where spreads are, the fact that WTI is sitting at 87. So before we move on, we just want to call attention to the fact that we did an update on Russia, Ukraine in segment 1 of the Econ show. We know that the geopolitical risk is real. That continues to be at the front point of people's minds. In the insights, we're doing a deeper dive into the UAE, Iran, Houthis, and Saudi Arabia. There's going to continue to be a lot of activity back and forth. The port that the Houthis now operate, that as of November of last year, allows them to bring in more missiles, more drones, and you saw that used to a fairly successful range when you look at the attack on the UAE and Saudi Arabia. So Saudi responded again with another high value airstrike. We think this is going to escalate. So while people are looking at what is happening in the Ukraine and Russia, which we don't think in the near term there's going to be a problem, and our base case is that there may be one clash, but we don't see an all-out invasion. But we do see things heating up a bit in the Middle East, especially when we consider Yemen versus Saudi Arabia and in the UAE. But please look at our insights for more. So now when we look at the Dubai spread, we're right at $4 WTI versus Dubai. Given some of the pricing, we see this going over $4 and keeping more pressure on U.S. crudes going into Asia. This makes it difficult, so Asia would much rather purchase something from the Middle East and or from West Africa versus from the U.S. at these pricing points. Gasoline exports had another drop. We were expecting it to move a little bit closer to the low end of the of the bottom of the cloud. Instead had one more drop. We do expect it to bounce back up into the low end, but still remain out of the normal range, just given where demand is globally, where there's still a lot of floating gasoline, and there's not a whole lot of demand at this point in time. Now, when we look at distillate, you can see distillate had a drop. Seasonally speaking, there's normally a drop right now. It just came in very on the low end. We expect it to move along seasonal lines, but still remain well out of the 5-year average and much closer to the bottom end of the cloud. So now when we look at ethane had a drop. When you have an ethane cracker, you can't replace ethane with a whole lot because of the way the cracker operates. So even though naphtha prices have come down, if you have an ethane cracker, you have to run ethane. So we do expect to see ethane exports remain well above the 5-year average and likely above the top of the cloud. Now, when we look at U.S. exports, again, right in the middle of the road, and we expect that to remain. And then when we look at the 4-week rolling average, as we said, we expect it to be closer to about 2.6 to about 2.7 million barrels a day, just given where the flow is going into Europe, but again, more pressure on Asian exports. Now, when we look at propane, you can see that we had a sizable drop to the low end of the cloud. We expect this to bounce, but just back to the 5-year average because of some of the pricing headwinds that we highlighted, which will keep things a bit slower. And then we should have a bit more demand in the U.S. just given how cold it is going to get. Now, when we look at some of the market right at this point, so two pieces to this. One, Libya is back to about 1.2 million barrels a day of production. That should continue. When we look at the CN pipeline, there was an explosion where that shut it down. It moves about 450,000 barrels a day from Kirkuk to CN, the CN port in Turkey. It was shut down for about 12 hours. It wasn't an attack. A power line failed, so they shut it. They shut it down as a precaution, but it is now back up and running, so we shouldn't see too much of a hiccup just because of the delay was fairly short. When we look at Russia, Russia is going to move back to about 3.9 million barrels a day of exports. When you look at what's happening in February, Angola is coming down again, and it's just because demand has slowed. So things started out really well, sold out February, and now they're seeing their demand for their crude slow down in February, and that's bleeding now. Into March, and that's just because of the front-ended buying that we saw. That, again, is still leaving a lot of crude on the water in West Africa. So Nigeria, we're seeing some increases for March based on what we're seeing. So we should be a bit closer to January loading levels versus February. But so far, February has been a bit slower than they would have liked when you're looking at buying. On the other side, the other purchases from Congo sold out for Feb. Things look fairly stable on that front. Mediterranean, North Sea, again, fairly stable as Norway continues to remain a bit elevated. So really not too much has changed on that front. But then when we look at the spot market and we want to look at some of the physical moves, so Surrogate sold Urals cargo, crude cargo in Feb, sold at a discount of about 80 to 90 cents to dated Brent. At the worst, it was trading at about $2.50 to $2.60 discount. So it's tightened to about $1, about 80 cents to $1 versus dated Brent. That's still a bit tighter, but as Libya comes back, as CPC normalizes a bit, we should see this drift lower, but just based on where demand is, still remain above that low point that we saw. Buying interest for CPC blend from Asia remains fairly robust with at least 8 Suezmax cargoes for February moving across. But then when you look at what those blends are showing, so the blends actually came in at a bit of a discount. So right now there was an offer out there for about $1.25 below dated Brent, and the last offer that crossed was at about negative 85 cents. So again, you're starting to see a little bit of a slowdown, and that's just because a bit more volumes are coming back. Weather's improved a touch, which has increased. Now, Surrogate sold 3 cargoes of Russian ESPO for March loading at a premium of about $4.70 to $5.10. In February, it got to about $4.90, which is about $3 off of peak, $3 to $4 off of peak. But it got almost $2, and now you're starting to see this climb a bit higher, which just shows that you're getting some guys taking advantage of pricing due to location, and that's something that we think is going to remain. So things are still tight, not as tight as they were last week, but still remaining in a fairly robust form. So crude oil storage in Europe increased a bit. You can see that seasonally adjusted, it's still at a seasonally adjusted low. We expect it to remain fairly stagnant at this point and falling back within the low end of that cloud. So then when we look at activity, so here you can see gas oil had a sizable drop of 144. Seasonally speaking, we're still at a seasonally adjusted low. We expect it to stay fairly tight in this range. So the comps get a bit easier. So it'll just fall within essentially the low end of the cloud, but still in a very robust spot. We still see diesel, middle distillate as really the bright spot when we're looking on a global level. Gasoline had a small drop of 47, but again, still at a fairly elevated rate. So when we look at gasoline had, again, that small drop. It's still well above that 15-year average, and we expect it to remain elevated as some of the driving activity continues to slow within the country, just given Omicron, weather, just given where some of the things sits and cost in general. So now when we look at fuel oil had a bounce. We expect to see some of this fuel oil continue to move into the market as middle distillate prices, low sulfur, ultra low sulfur diesel prices remain elevated, accelerating the consumption of high sulfur diesel, high sulfur fuel oil, which will be a movement from Europe into the rest of the world. Now, when we look at Singapore, things happen pretty similar to what we were saying. Singapore had a build from the middle distillate had the biggest spike from 7.2 million to 8.5. So we had some of the cargoes that we were seeing finally show up. When we look at the total went from 43.2 to 43.3. So still above the 16-year average or so, 17-year average or so, and it'll still remain, I think, fairly elevated as we go through the remainder of January and February, with again middle distillate being the bright spot as light distillates and residual continue to build. Now, when we look at light distillate, again, staying at the high end of the range, we see that remaining as we go through the few months and actually drifting higher as demand for gasoline continues to come under pressure as Omicron spreads within Asia, which is where we see some of these cargoes. And you're seeing some some exports increasing, which again is just putting more on the water and ending up in storage. So middle distillate, we got that spike that we were expecting. It came a week later than we thought, but still ending right at the same level. We expected to move up a bit more, but still remain fairly robust, fairly strong, and in a very positive light as we look at where some of the demand is throughout the region, especially when you look at some of the shortfalls for diesel in the market, especially in Asia. While on the residual side, we kissed the seasonally adjusted all-time high, pulled back a bit. We're still going to remain right at the seasonally adjusted all-time highs, just given where demand is and where the excess remains for resid. Now, when we look at inventories, so when we look at the total stock rose by 1.578 million barrels, and a lot of that was driven by middle distillate. So the total stock builds was driven by rising middle and heavy disti with light distillate small draw. So we had a small draw in light distillate of 374,000 barrels. But even though we had a small draw, the East of Suez gasoline market still remains under pressure as there's an uptick of regional supply availability reflected in more spot supply tenders this week, which, as we've been saying, as Omicron grows, we're starting to see things more slack in the East of Suez side. We already had it in the West of Suez. That's now going to the other side of the canal, and will keep a bit of some of that slowdown in underlying, I should say, excess availability. Now, on the middle distillate side, the product rose by 1.18 million barrels, which is almost 100% increase. So it essentially doubled to about 2.426 million barrels, which is what we were expecting. It's just we thought it was going to have some slower builds, but instead it all came at once. Welcome to the the world of trying to call these things when you can see the boats. When is it going to recognize? When is it going to go from international waters into the territorial waters? And this is the fun that we have. So East of Suez gas oil market saw backwardation continuing to steepen as tight supplies boosted near-term market sentiment. But when you look at some of the near-term availability, you're starting to see a bit more cargoes come available, and that's softening some of the bullishness. And that could persist in the next few months amid some lower exports of oil products. But right now, we're starting to see some of that come on. So we expect to see middle distillate remaining in a fairly in a bullish backdrop. But some of the bullishness could soften a touch. But again, still remaining in a bullish uptrend when you're looking at diesel. Heavy resid rose by 772,000 barrels, or 8.4% on the week. Demand for bunker averaged, but your bunker fuel sales at Fujairah inched lower for the second consecutive month amid a slowdown in shipping activity, though it was still the third highest sales volume across all months in 2021. So again, you're starting to see some of that slowdown, some of those headwinds, but a lot of that is due to supply chain issues, as we saw delays coming out of China. So we are seeing some of those headwinds on the heavy resid side. Looking at time spreads, continued to surge, pulled back a touch in Brent. We saw something similar happen in WTI, but now as this front month rolls off, we'll get a new front month, and we're starting to see some of the softness in time spreads while still elevated, just kind of normalizing a bit. Now, when we start looking at refinery spreads and crack margins, you can see that on the hydrocracking side, refinery margins remain fairly elevated, and it really comes down to the middle distillate cut diesel side continuing to stay fairly strong as the light hydroskimming side remains under pressure, and that's where we start looking at naphtha versus blending versus gasoline. So again, the heavier cut still remains fairly strong, which is being reflected here. And as you can see at this level, but also this kind of crack spread is also going to incentivize more middle distillate. So this is why we do expect to see a bit more coming into storage, just because storage remains widely available. The price is right, the demand is there, so we will see additional middle disti. On the Ural side, something similar when we're looking at hydrocracking versus other. As Libya becomes a bit more stable and available, CPC as well, we expect to see some of this pull down. But again, hydrocracking remaining the bright spot given how tight gas oil is in the European market. And the same thing is playing out again in the Mediterranean, where other things are kind of flatlining while the hydrocracking gas oil function continues to be the bright spot. Crude supertanker crude imports dropped, similar to seasonal norms, but we expect to see some of this increase as some of these ships show up, given the amount of buying that happened. But remember, there is that timing delay. And December was a very slow buying month. So you had ships that were bought in October and November already showing up and already have shown up. Now you get that lull, and then we'll get another increase for the buying that happened in January, rolling through in February and March. And that, again, is going to shift some of the Asian floating storage. You can see that we had a nice drop, which, as we said in segment 1, was some of that movement from offshore to onshore. We do have some of these additional ships showing up, so we do expect it to be a bit more of a sideways move and be fairly close to where we were in 2021. Now, when we look at the North Sea is fairly flat. We do have this grinding a little bit closer and getting back to the 5-year average over the next 2 weeks. When we look at West Africa floating storage, you can see that there was a decent reversal. We're at seasonally adjusted all-time highs. This is where we continue to see this backdrop, because the bullish narrative is they're producing well below their quota. But then when you look at where things are, it's like, why am I going to produce at my quota if I have so much in floating storage? Because if I produce it, I have to pay for storage. If I leave it in the ground, no paying of storage. So again, these are some of the things where we really want to see this clear. And as this clears, you should see additional production, additional activity. But given these levels is one of the reasons why Angola is pulling back on their loading schedule in March. Middle East, on the other hand, continues to grind a bit higher. You can see that when we look at it against 2020, 2021, and some of the normal months, you can see that we're grinding higher. Now, this is why we think there's going to be another OSP cut, just because there's starting to be a bit too much in floating storage, I think, for their liking. And this is going to be important to see. Does it continue to grind higher? If it does, that would incentivize an additional cut. But given where some of the softness is you're seeing some tightening in Russia, a little bit of softness coming back into CPC, still some healthy demand for Asian products. But this is going to give a clear indication of, are we going to see differentials loosen a bit? Because as you can see, they tightened. This was low, but as this starts to expand, that will have a bit more of an indication on the pressure points as we go into the remainder of Jan. Europe is falling back in the low end of the curve. We expect this in the cloud. We expect this to remain at the low end of the cloud, just given where some of the shifts are. And now when we look at Shandong independent refinery utilization rates, you can see that we're right below the 5-year average. And we expect that trend to continue, not only because of maintenance season, but also because of the Olympics. And this is going to put a damper on some of that crude demand, putting some additional crude in storage and leaving some offshore. So that's everything we have for you today. That hits on everything. If you have any questions, please let us know. You can find me on Twitter. You can find me in the comments section. And thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.